The question everyone gets wrong. If you're new to investing right now, the question you're probably asking is this a bad time to start? And I get why. The S&P 500 has had a weirdly strong stretch. According to Slick Charts, it was up about 25% in 2024, 17.9% in 2025, and roughly 8.1% year to date in 2026 as of June 25th. That sounds great if you were already invested. It sounds awful if you're just showing up now because nobody wants to be the person who walks into the party 5 minutes before the cops arrive. But I think beginners are asking the wrong question. The question isn't, is this the perfect time to invest? It's, what system can I follow even when the market makes me feel stupid? Because if you're waiting for the market to feel safe, congratulations, you've discovered cash. It always feels safe. It's also kind of the problem. Why this feels especially confusing right now. The beginner investing advice online is usually either way too calm or completely insane. One side says just buy index funds and never think about it again, which is mostly right, honestly. The other side says the market is rigged, AI is a bubble, the Fed is ruining everything, inflation is back. Buy gold, buy crypto, buy canned beans. Also, not totally detached from reality, just maybe not the best portfolio strategy. The current market actually gives beginners a useful lesson. Stocks can be doing well and still feel uncomfortable. CNBC's market page recently had stories about tech weaknesses, AI trade concerns, prices moving around, geopolitical tension, tariffs, and investors rotating away from certain high flying technology stocks. Stock analysis had a similar tone. Tech volatility, AI concerns, inflation worries, and market uncertainty all showing up at once. So if you feel like, wait, are stocks good or bad right now? Yes. That's the annoying answer. Stocks are ownership in real businesses. Real businesses make money, lose money, disappoint people, surprise people, overhire, underinvest, panic, recover, and occasionally spend billions of dollars on AI infrastructure that investors suddenly decide to question. The market is not a mood ring, it's a messy auction for future expectations. And beginners usually get hurt when they treat it like a scoreboard. The first rule, don't invest money that has a job soon. Before we talk about stocks, index funds, ETFs, whatever, there's a boring sentence that could save you from doing something dumb. Don't invest money that has a job soon. Rent money? Not investing money. Emergency fund? Not investing money. Down payment you need in 8 months? Also not investing money. FINRA's beginner investor guidance says to handle the basics first. Pay your bills, build an emergency fund, ideally 3 to 6 months of expenses, and deal with high interest debt like credit cards before investing. That advice sounds boring because it is boring. It is also correct because the market doesn't care that your transmission died. If your emergency fund is sitting in the market and stocks drop 20%, now you don't have an investment strategy. You have a garage bill and a panic sale. And that's how beginners turn temporary market decline into a permanent personal loss. I know everyone wants the exciting part, the tickers, the charts, the what should I buy? But the real first investing skill is not needing to sell at the worst possible moment. That is deeply unsexy, but it is also most of the game. What you're actually buying when you're buying stocks. A stock is not a magic number on your phone. It's ownership in a company. Tiny ownership, usually like you own a crumb of the building and not even a good crumb ownership, but still ownership. If the company grows, earns more, returns cash to shareholders, or investors become willing to pay more for those future profits, the stock can go up. If the company disappoints, gets overvalued, loses money, gets disrupted, or investors decide they were too optimistic, the stock can go down. That's the individual stock version. Then there's the beginner friendly version, diversified funds. An S&P 500 index fund, for example, doesn't ask you to pick one company. It gives you exposure to hundreds of large US companies in one package. Important detail, you cannot directly buy the S&P 500 itself, it's an index, but you can buy ETFs or mutual funds that track it. And this is where beginners need to be careful because diversified does not mean risk-free. Investopedia notes that as of May 2026, the so-called Magnificent Seven, Alphabet, Apple, Amazon, Meta, Microsoft, Nvidia, and Tesla, make up about 34.7% of the S&P 500's market value. That is a lot. So yes, an S&P 500 fund is diversified compared with buying one stock, but it's not some perfectly balanced basket where every company gets an equal vote. The giants matter a lot. That doesn't make index investing bad, it just means you should understand what you own instead of treating index fund like a religious object. The number everyone quotes and why it's dangerous. You've probably heard that the stock market returns around 10% a year. That number is not made up. Trade That Swings long-term data shows the S&P 500 averaging about 10.6% per year over the last 100 years, with dividends reinvested as of May 2026, adjusted for inflation, the number is closer to 7.4. Official data shows a similar long-run story. $100 invested in the S&P 500 in 1926 would give you about 1.93 million by 2026 with the dividends reinvested, which works out to about 10.34 per year. That is ridiculous. $100 becoming almost $2 million is the kind of number that makes compound interest sound fake. But there's a trap. The market does not hand you 10% every January like a gift card. Stock chart shows S&P 500 total return was minus 37% in 2008, minus 18.1 in 2022 and 31.5 in 2019. That's not smooth. That's a washing machine with your money in it. The long-term average is real, the path to get there is rude. And if you're a beginner, that matters more than the average because the average is what you earn if you can stay invested. The volatility is what tries to shake you out. Dollar cost averaging. Boring, useful, over misunderstood. This is where dollar cost averaging comes in. Dollar cost averaging means you invest the same amount on a regular schedule. Every paycheck, every month, whatever, regardless of what the market is doing. FINRA defines it basically that way, equal portions, regular intervals, regardless of current market conditions. If you contribute to a 401k every paycheck, you're probably already doing it. The benefit is psychological as much as mathematical. You don't wake up every Monday pretending you're Jerome Powell with a Robinhood account. You just invest on schedule. When prices are lower, your fixed contribution buys more shares. When prices are higher, it buys fewer. Fidelity gives a simple example with $25 recurring investment, showing exactly how the share count changes as prices move. But I want to be honest about the counterargument. Dollar cost averaging is not magic. FINRA points out that if you have a lump sum sitting in cash, spreading it out over the time can reduce the short-term regret, but it can also lower returns if the market rises while you're waiting. That's the annoying trade-off. Lump sum often wins mathematically because market tends to go up over long periods. Dollar cost averaging often wins behaviorally because humans are emotional little raccoons who panic at red numbers. And for beginners, behavior matters. A perfect strategy you abandon is worse than a decent strategy you can actually follow. The part beginners skip, asset allocation. Most beginners investing content jump straight to what ETF should I buy? That's not the first decision. The first decision is asset allocation. That means how much of your money goes into stocks, bonds, cash, and maybe other assets. The SEC's beginner guide explains this in plain terms. Asset allocation is dividing your portfolio among categories like stocks, bonds, and cash. The right mix depends heavily on your time horizon and risk tolerance. Translation: money you need in 2 years should not be invested like money you need in 35 years. Stocks have historically offered higher returns, but they're volatile. The SEC says large company stocks as a group have historically lost money about 1 out of every 3 years. The line deserves more attention than it gets. 1 out of 3 years. Not because stocks are broken, but because volatility is the price of admission. Bonds are generally less volatile but usually offer lower returns. Cash is stable, but inflation can quietly eat it. So the beginner question becomes, how much volatility can I survive without doing something dramatic? Not tolerate in theory, survive in real life, because everyone has high risk tolerance during a bull market. Risk tolerance shows up when your account is down, your group chat is panicking, and some guy on YouTube with a shocked face thumbnail says the crash has just begun. That's when your allocation either helps you stay calm or exposes the fact that you built your portfolio for a version of yourself who does not exist. Fees, the tiny leaks that becomes a flood. Fees are boring until you realize they're stealing from future you very politely. FINRA says even a small percentage difference in fees can eat away a big chunk of returns over time. That's not dramatic, that's math. If two funds do basically the same thing but one charges much more, the expensive one needs to justify its existence. Sometimes higher fees pay for something real: active management, niche exposure, advice, planning, fine. But a lot of beginners accidentally buy expensive products because the app made them look official or because a fund name sounded sophisticated. Please do not pay extra for vibes in a PDF. Look for the expense ratio. That's the annual fund operating cost. Mutual funds and ETFs have them. Lower is not automatically better in every case, but if you're buying a broad index fund, cost matters a lot. Also, zero commission tradings does not mean investing is free. FINRA points out the other fees and charges can still apply. The app may be free, the mistakes are not. The 2026 reality check. So, should a beginner invest in stocks today? My honest answer: yes. If the money is truly long term, your emergency fund exists, high interest debt is handled, and you have a plan you can keep following when the market gets ugly. No, if you're trying to turn rent money into a personality. The relevance of stock investing in 2026 is not that stocks are guaranteed to be cheap or safe or about to explode higher. They might be expensive, parts of the market look stretched, tech concentration is real, AI excitement has clearly pulled a lot of oxygen out of the room, inflation and interest rates still matter, geopolitical risks still exist. Pick your anxiety flavor. But the case for beginner investing was never buy because everything looks perfect. The case was own productive assets over long periods, diversify, keep costs low, automate what you can, and don't confuse volatility with failure. That's the whole thing. Not easy, simple. And there's a difference. The beginner who wins is usually not the one who finds the perfect stock. It's the one who avoids the obvious traps, investing money they need soon, buying hype at the top, panic selling during the drawdowns, ignoring fees, and changing strategies every time the internet changes tone. If you can avoid these five mistakes, you're already ahead of a lot of people who sound very confident online, which is a low bar, but still, clear it. So to wrap it all up, remember the opening question? Is this a bad time to start? I think the better answer is it's always a bad time to start if you need certainty first. Markets don't give you certainty. They give you risk, reward, boredom, regret, occasional euphoria, and long stretches where doing nothing feels wrong even when it's the correct move. My actual opinion, beginners should not be trying to outsmart this market. They should be trying to build a system boring enough to survive it, because the stock market has rewarded patience historically. It has not rewarded people for needing to feel cleverer every Tuesday. And if that sounds disappointing, good. Disappointing is probably healthier than whatever investing TikTok is doing this week.